Hey everyone, welcome to today's Explainer. We're going to demystify a totally hidden market force that's directly affecting everyday retail investors just like you. So if you've been pulling your hair out trying to make sense of the market lately, well, you're exactly in the right place. Okay, let's dive into this.
Part 1, the market's hidden threat.
I mean, there's so much confusion right now. You're trying to plan for your financial future, but economic conditions just seem so stubborn, right? Think about this question. Why won't mortgage rates fall? We're seeing sudden stock market freakouts practically every few months, and financial conditions somehow feel incredibly tight despite all this endless talk about Fed rate cuts. It honestly feels like the rules of the game just keep changing behind the scenes. Usually, we point our fingers at the obvious stuff, the AI bubble, China, maybe whatever's happening in Washington politics. But the actual real threat to the stability of your portfolio, it's none of those things. It actually starts all the way over in Tokyo with literally the most boring asset on earth, Japanese government bonds. Japanese government bonds, or JGBs, have essentially been the financial duct tape quietly holding the entire global financial system together for the past 30 years. I know that sounds like a massive statement, but it's absolutely true. And what we're exploring today is what happens when that 30-year-old financial duct tape, well, finally starts to peel off. Let's move to part 2, Japan's zero interest era. Okay, so let's jump in a time machine back to 1992. Japan's massive asset bubble bursts. Real estate collapsed, equities collapsed, and they entered this long, grueling period of zero real growth, no inflation, and stagnant wages, a period widely known as the lost decades. Out of sheer desperation, the Bank of Japan cut rates to zero. Then they went below zero. And when even that wasn't enough, they rolled out a policy called yield curve control. They essentially superglued interest rates to the floor, actively capping long-term bond yields, totally ignoring what the free market actually wanted. But here's the thing. By pinning yields to the floor, they created a massive headache for their own domestic investors. Japanese pension funds, life insurers, banks, they faced a huge dilemma. Picture this. You're managing a billion-dollar portfolio, and your safe domestic government bonds pay you exactly 0%. You basically have two choices, right? Accept a 0% return or go shopping overseas. Obviously, they chose option 2. They went on a multi-decade global shopping spree and eventually became the largest foreign holder of U.S. Treasuries and U.S. mortgage-backed securities. Which brings us to Section 3, the yen carry trade. So, how did Japan become the world's ATM? Let's walk through the simple math using a hypothetical investor. Let's call him Bob. Step 1, Bob goes to the Japanese markets and borrows money in yen at a near zero interest rate. Awesome, right? Step 2, Bob converts that yen into US dollars. Step 3, Bob turns around and buys US treasuries, yielding, let's say, 4%. After covering a few basic hedging costs and fees, Bob pockets the spread. He is literally manufacturing free money out of thin air just by exploiting that interest rate difference between the two countries. That is the famous yen carry trade. And this brilliantly illustrates how global markets were essentially running on free Japanese Wi-Fi. Because borrowing costs were near zero, investors like Bob didn't just stop at boring old safe US treasuries. No way. They took that free yen and bought US tech stocks, real estate, emerging markets, you name it. Basically, if an asset had a pulse and yielded more than 0%, this cheap capital scooped it up. Trillions of dollars in global liquidity were pumped into the system. But then we hit Section 4, the 2024 reversal. This entire massive system, propping up trillions of dollars in global asset prices, relied on one fundamental assumption, that Japanese interest rates would stay near zero forever. But in 2024, that assumption totally broke. The Bank of Japan actually ended its yield curve control policy and raised interest rates for the first time in 17 years. Boom. Suddenly, borrowing in yen and hedging against currency risks became way more expensive. The math completely flipped, and that long, beautiful free money era came to a grinding halt. And you better believe this shock factor was immediate. Right after Japan's second rate hike decision, the US S&P 500 dropped a staggering 6%. And it was even worse over in Japan. Their primary index, the Nikkei 225, plunged over 12% in a single day. That was its absolute worst drop since 1987. Markets were officially and fundamentally spooked. So why the panic? It comes down to repatriation. That's capital flowing out of foreign investments and returning back home to Japan. When the math of the carry trade flips, the capital flows flip right along with it. And this is honestly one of the biggest threats to global markets today because the absolute cheapest source of global liquidity is rapidly drying up. Just to give you an idea of how serious this is, listen to this quote from legendary investor Ray Dalio. He says, "The bond market is the basis, it's the backbone of all markets. It determines what all asset returns are going to be." It's so true. When there's a breakdown in the supply and demand for bonds, it changes the foundational interest rate for literally every single asset class on the planet. Now, what's really interesting about this slide is the contrast in what actually drives the economy versus what the media obsesses over. We all hyper-analyze Jerome Powell and the Federal Reserve like it's a blockbuster movie trailer. But the Fed really only controls short-term overnight rates. The long-term rates, the 10, 20, and 30-year yields that actually dictate the broader economy, are largely determined by pure supply and demand. And for decades, Japan was the ultimate price-insensitive buyer providing that steady demand.
Section 5. Risks for retail investors. Let's bring this home.
So, the crucial point is understanding this domino effect on retail investors. If Japan, which again is one of the largest historical buyers of US debt, starts backing away, yields have to rise to attract new buyers. This creates what's called a steepening yield curve. Basically, Japan backing away means long-term rates stay elevated, and that hits three critical areas for everyday people. Stock valuations compress, mortgage rates stay high, and corporate credit tightens. Let's start with your stock portfolio. When financial analysts build their models to value a stock, they discount a company's future cash flows using those long-term treasury yields as the baseline. If those long-term yields are elevated because Japan isn't buying, the present value of a company's future cash flow shrinks. It's just math. This means stock valuations compress. So a company's earnings could be totally fine, business is booming, but the actual price investors are willing to pay for that stock drops. That makes your portfolio inherently unstable, even on days when the news headlines seem perfectly calm.
Next up, buying a home. We all know how tough that is right now. Mortgage rates aren't pulled out of thin air. U.S. home loans are largely anchored directly to the 10-year Treasury yield. So the Federal Reserve can cut short-term rates all they want, but if global demand for our long-term treasuries weakens because that Japanese money went home, the long end of the yield curve stays pinned high. And that means mortgage rates stay high. Housing affordability stays incredibly strained, nobody's refinancing, and real estate transactions basically slow to a crawl.
Finally, let's look at corporate credit. Credit is basically the bloodstream of the entire corporate world. Think back to a few years ago when money was practically free. Companies borrowed aggressively, they expanded, they hired like crazy. But when long-term borrowing costs remain elevated, risk appetite falls. Capital tightens up across the whole economy. Growth slows down, deal flow dries up, and companies have to play defense. And that, of course, trickles down to affect the job market and your overall economic health. We are constantly sold this super oversimplified narrative that one Federal Reserve rate cut is just going to magically fix everything, right? We assume market liquidity is just automatic, but liquidity is the oxygen of the markets. And for 30 years, we benefited immensely from being on the receiving end of the world's largest carry trade. So I want to leave you with this provocative thought to chew on. As Japanese institutions reallocate their capital back home and the cost of money changes everywhere, what happens to your investments when the world's ATM finally stops dispensing cash? The real threats in the market aren't usually the loud ones on the news. They're the silent shifts hiding in plain sight. Keep your eyes on the foundation.